First of all, venture capital, especially institutional venture capital like ours, is really only for a very small fraction of companies. I blame Shark Tank for making it seem like anybody can walk into Mark Cuban and 15 minutes later have an answer and a couple $100,000 in your pocket. It just doesn't work that way. And the truth is and it's even different for an angel investor versus fund like us, where the types of returns we need are just so astronomical to return our investor capital.
Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. Nick Adams is the co-founder and managing partner of New York-based seed fund Differential Ventures. Previously, Nick was a venture partner at Supernode VC, FKA Flatiron Investors, where he evaluated seed stage tech companies and led the due diligence for multiple investments. Before joining the venture community, Nick held senior sales, marketing, and product management roles for software companies that realized over $1.3 billion in exit value, including a list of companies that you can check out in the show notes. They'll be there. Nick actively mentors startups out of Cornell Tech, NYU, and Northeastern University, and is on the board of a nonprofit dedicated to support venture-backed startup founders. He's also an investor on ZTV's startup show Break Through the Crowd, which follows the journey of several entrepreneurs. Nick has an MSc in Global Finance from NYU and Hong Kong University of Science and Technology, an MBA in Corporate Finance from Northeastern University, and a BA in History from Brandeis University, where he played 4 years of varsity baseball. Nick, welcome to the DealQuest podcast.
Hey, Corey. Thanks for having me. Great to be here.
Yeah, it's great to have you on, man. And, I'm always interested in folks that help companies raise capital. It's been a bit since we've had anybody on sort of, on the VC side, on the seed funding side. And obviously we are in a different world than we used to be. So we're going to talk about the world generally and the world today and what we think the world's going to be soon. But before we go to the here and now, I want to take you back to when you were growing up as a little kid, maybe 8, 10, 12 years old. And what did you want to be when you grew up? Because I doubt it was a venture capitalist, but maybe I'm wrong. You tell me.
No, you're right. I didn't know what venture capital was until I was 22. Certainly not that. I wanted to be the shortstop for the Boston Red Sox. Probably something you're not an answer you're too fond of, but that was the truth.
I love it. DealQuest listeners, we had a little pre-discussion about our sports alliances, and although Nick has become a New Yorker and a huge fan, he has, in my mind, rightfully kept his alliances to his old teams. So being a New Yorker, we had a fun discussion about that. So yeah, and it sounds like you made it through to from your bio through to college on the baseball level, and then the career ended there.
That was it, man. If you've seen the movie Moneyball, there's a great line in that movie that says, we're all told we can't play anymore. Some of us are told at 18, some are told at 40. Well, for me, it was 22. That was it. Last game was played, got knocked out of the tournament. No scouts called, no teams drafted. So it was on with life from that point.
Got it. Love it. And one more question looking back. What was your first deal, first real deal of any type? It could be something when you were a kid or older, whatever comes to mind.
I'm actually going to stick to something work-related here because it was so memorable and such like an iconic company for me. The first ever company that I sold, software to and closed the deal was the A&P Supermarket. The Great A&P Tea Company, I think it was called, was the formal name. Yeah. Being a Jersey guy, you probably know something about them. They're now bankrupt, but they were like the iconic supermarket in the United States for a very long time. And they were my first customer using accounts payable automation software, if you can imagine the excitement of that.
Wow. Yeah, no, I remember I grew up in Brooklyn, New York, and lived in New York for a long time, and then moved to New Jersey. And yeah, A&P was, A&P was one of the big supermarket chains, no question.
Yeah, we have them in Boston. I mean, they were everywhere. My uncle worked there. My best friend's dad worked there. That was like the place to go.
Love it. So take just a couple of minutes at a high level to tell folks what you do now at Differential Ventures. And most people understand it, but for those who don't, understand what the difference is in terms of seed investing versus later stage investing, and then we'll get into some specific questions around deals.
Yeah, sure. So before coming into venture, I worked in the technology world, obviously. So sold a lot of software and basically ran sales, marketing, and product management for a few different companies that did pretty well. Moved into venture capital about 5 years ago. And our focus is really on investing at the earliest stages of companies. For us, it's usually not quite idea stage, but it is oftentimes pre-revenue. So for us, we're getting in there. We're oftentimes the first institutional investor into a company after they put some of their own money in, or maybe raise some money from friends and family or outside angel investors. So we come in, usually we invest somewhere between $250,000 to say 1.2 million into a seed round of, let's say, $2 to $4 million. From that point forward, we usually join the board or take a board observer seat and work very closely with the founders to kind of do everything in the early stages of a company. And this is really where things differ between early stage venture capital and late stage venture capital, as you pointed out. I think the term venture capital has really become bastardized over time. And I can tell you what I do at the seed stage and what our team does is drastically different from what somebody doing a Series B, Series C investment is. It's like, picking a stock and then teaching the management team how to, sell, market, maybe build product and, look for those first few customers to take a chance on a brand new company.
Many of our listeners are pretty sophisticated in this and understand the progression of funded companies, but many don't, may not. And so, just to clarify a couple of things, I mean, when companies raise money, a lot of times, right, it's initial, maybe their own money, maybe friends and family round, or maybe not even such a formal round, maybe it's some money from mom or dad, right? And then there's the potential for angel investors, which are just, wealthy, smart people you may know or have get in contact with, may put in some money. And then you get to the seed stage, investors, which is what Nick was talking about. And then you get into, you'll hear Series A, Series B, Series C, which are, rounds of later stage or increasingly later stage venture funding, with an eventual exit that theoretically could be a public money in the public markets, but is more often, although that's the dream, is more often, an acquisition or sale if the company's successful. So, in that progression, the seed stage is, like Nick said, it's not idea stage, but it's pretty early. And so, these are companies, Nick, right, that don't have, they do have an idea. Obviously, they've started doing some stuff. They may have some of their management team in place, but usually they probably need management team help, right? Talk about some of the, what companies in a little more detail, what companies at this stage need that you help them provide either, in-house or through introduction.
Yeah, great question. It varies company by company is the obvious statement. And then it also varies as each company progresses or doesn't progress. So it's really interesting. My days can be pretty varied in terms of what I do. But, usually at the earliest stage, what we're doing is, just like you said, we're usually investing. I think we have a bit of a predisposition for more technical founders because everything we do is investing in technology, largely with a focus on data science, AI, machine learning. So it just sort of leans towards more technical founders. But then we're also looking to see, is that founder or one of their business partners, co-founders, good enough, strong enough to continue building the product out to get to that MVP and first initial version of something that people will pay for? And can they support that growth and get to, let's say, $2 million in recurring revenue? And can they do it fast enough so that our round of, let's say, $2 to $4 million, like I said, at the seed stage, gets them there without needing additional capital? So it is a bit of a velocity game as much as a pure technology skills or sales ability.
Let's take a break from the show for a minute so I can invite you to join our DealQuest community group on Facebook. There, you'll have a chance to engage with other entrepreneurs, business owners, executives, and leaders who are looking to grow, do deals, and make a bigger impact. In addition to the great content and community, you can also register there for our Conversations community and cocktail Zoom calls and the upcoming Deal Den Zoom calls, during which you will have the opportunity to brainstorm and get support with deal-driven growth for your company. Now back to the show. So let's talk about that comment about a velocity game. It was interesting. I have a good friend and client. We do some of his work. Who's in a robotics startup in the construction industry that he created, and he's at seed stage. And some of the business decisions, we don't. Like I said off air when Nick and I were talking, we don't handle the securities work anymore just because that's become such an area where there are firms that just do that over and over again. So we'll bring somebody in. We often stay involved on the legal side, because we've done their initial, corporate setup, contracts, that kind of stuff. And also because we really become strategic advisors. So he had some business decisions to make relating to growth and risk. And one of the things that, and you can tell me whether you agree or disagree on this, but people put this in a negative way, but it is what it is. It's often a positive way. That term velocity, when you are investing and people putting money in like you, the whole purpose is to put some gasoline on a fire, or maybe it's just some embers and turn it into a fire. That triggers, my friend in this case was getting some advice like, oh, that's risky, which by the way, us lawyers tend to, most lawyers tend to focus on the risk side, and that becomes a real tension with business people and VCs. And being an entrepreneur myself, I understand there's two sides of it. And my advice to him was to go ahead with that riskier thing. We would help mitigate the risk in the best way we can, because speed matters for firms in that stage. And there's, some velocity that's needed. Your thoughts?
First of all, I'll give you some credit. So the truth is, after my baseball career was ended abruptly, I was on track to be a lawyer. So I worked as a paralegal in a law firm, was going to go back to law school. So given the amount of time I spend doing legal work and paralegal work now as a fund manager, negotiating deals and so forth, I have a lot of appreciation for what you guys do. So don't sell yourself short on that front. And then secondly is you're right. So the hardest decision with the fewest data points that we have to make during our diligence and investment decision process is the market timing favorable enough for this to take off. And, people ask me all the time, what's important, team, the technology, or the product? And the technology or the market. And the reality is it's market and then team and technology after that. So the market's not there and the timing's not right. You're just as bad off being early as you are being late in a lot of ways.
Right.
So that's definitely the biggest thing we wrestle with.
Yeah, I love it. Let's talk about, let's go right to, because there's a lot of things people hear out there who haven't raised money about the advantages and also, these horror stories, right, about raising venture capital, right? The founders getting pushed out at some point, the pressure to grow. And, in my view, but there's a couple of things. One, you got to know what you're getting into. You change. It's a very different road when you become a venture-backed company, when you don't take outside capital, especially, at the VC level. friends and family are different, number one. And number two, the circumstances, and I don't want to hear it from you, the circumstances under which a founder loses control, quote unquote, or gets pushed out are often seen sympathetically to the founder. And sometimes that's accurate. But, sometimes it's just more around, capital planning and not hitting projections and not being the right person anymore. And, so I would love you to talk about those, two things. Like, let's hit on the, on the myths and the realities of taking in venture capital, the good and the bad.
Yeah. So, God, there's so many things in there you could probably unwind. Yeah. First of all, venture capital, especially institutional venture capital like ours, is really only for a very, very small fraction of companies. I blame Shark Tank for making it seem like anybody can walk into Mark Cuban and 15 minutes later have an answer and a couple $100,000 in your pocket. It just doesn't work that way. And the truth is and it's even different for an angel investor versus a fund like us, where, the types of returns we need are just so astronomical to, return our investor capital. So first and foremost, you really need to know if your company is something that, could warrant venture capital investment from the outside. Secondly is, sure, there are times where companies implode or things don't go right and there's a change made, at the C level of the company. But frankly, until a later point in the business, unless you really structured your investment and board and everything else in a bad way, there's really not a clear mechanism for VC to come in and just throw out a CEO whenever they want. It's usually, when it happens at the seed or even the Series A stage, it's usually, kind of a conversation and a process and more or less a mutual agreement for a CEO to step into another type of role or out of the company. But that's usually when you have a more technical founder who's like, I'd love to be the CTO of this company. I really don't want to be the CEO anymore. And that happens. And then there's the cases where things just go absolutely haywire, wrong, and changes have to be made. Those are pretty far and few between. So are there horror stories of what happens when you take outside capital? Absolutely. But I would say, if we break down like the venture capital asset class as a whole, I'm going to say most VCs are pretty good actors because our investors, our LPs, and our financial incentives and the way our funds are structured are pretty well aligned with very long, sometimes slow growth trajectory and illiquid nature of venture capital as an asset class. And those things are really, really important for a startup. What we see sometimes is, family offices or powerful angel investors or other types of private capital that aren't used to that type of illiquidity and long holding period and how damn slow things can be and frustrating things can be sometimes. Sometimes those investors put really different terms and can be a little bit more predatory, but just because their expectations aren't aligned with the nature of startups.
Yeah. And that's been my experience as well. I mean, of course, like in anything else, what gets a lot of noise is the horror stories and all the deals that work, right? Don't get, or frankly, even the companies that don't work because they don't, we know the success rate of plenty of companies that don't work, but it still doesn't mean, but still the relationship between the VC and the company was fine. It didn't get the traction that everybody wanted, right? So that, in my mind, those are the far majority of the cases. I think something you said was super crucial. And this is something that it's that initial conversation of who's right for VC funding, and it is a tiny percentage of it. I mean, most companies out there should never raise outside capital of any type, in my mind, right?
Yeah.
And then some companies, should get some friends and family money maybe, but like the percentage of companies that are really right, that are on that ability to have the kind of hyper growth, and also, frankly, who need the VC money because you wouldn't be able to do it without it, are such a small percentage of the total market out there.
Yeah, I just wanted to add just one, or take that one step deeper, because I think sometimes that's sort of abstract for a lot of people.
Sure.
But I was on a call the other day with a founder who was doing something, pretty cool in our thesis. During the call, he openly said to me, "Hey, I wouldn't be too upset if this had a quick exit of $50 or $100 million." I said, "Okay, then I'm not interested." He's like, and the guy was floored. He was shocked. He said, "What's your problem? Don't you like making money? Don't you like, don't you like getting returns?" And I said, I love both of those things. I said, but if you think about the dynamics of that for us, that's nearly a failure for our fund. Because if we have a portfolio of 20 companies and we're investing as early as we do, there's a good chance 10 of them are going to fail and our investment will go to zero. So we need to find these true outliers. And if he exits even for $100 million, let's say, and if I can own 5% of his company when he does it, which is, frankly, these days with how much money companies raise before going public or exiting is a challenge for a small fund like us.
Sure.
That's $5 million. Sounds great, right?
Right.
That $5 million is not going into my bank account or my partner's bank account. We have to give that back to our investors. I'm investing out of a $20 million fund right now. It doesn't really move the needle for us. So now we're down to 19 shots left, let's say, in our portfolio. And not that $5 million is a bad thing, but we need to believe that every one of our investments can return our entire fund, which means that we need to believe it can return $20 million. And if I want to be a 3x fund and perform in the top quartile of VC funds, our portfolio companies need to create, well over $1 billion of exit value in order for us to perform at that level. So it's hard. It's not for everybody.
Yeah, no, that's right. And I remember, I'm forgetting his name. I wish I can give him credit, but we had a professor from the London School of Economics who came in when I was president of the New York Chapter of Entrepreneurs Organization and spoke, and he had done a significant analysis on VC funds. And, and he said exactly what you said. And everybody sort of knows, you hear those stats that, if you invest in 20 companies, I'm making up numbers. It's not exactly this, but, the far majority, the majority of those are not going to give you any return. And then you're going to have a few that'll give you that $5 million return. And then you need a couple, one or two or whatever that, are going to, be the unicorns or or take off and have big returns. And that's sort of the way things work. So it was interesting. He got some real, statistics around that. So I get it. I mean, it's not like if you have a couple that really take off and you have a few that return $5 million, you're fine. It's just that coming into the game to have the mentality, that they're going to look to exit at that point, that really doesn't make sense for you guys. I totally get it.
Yeah, it's the unfortunate reality of our business. And, look, I think there's all sorts of other issues out there around, diversifying investments and creating more access and opportunity for people who have been excluded from this market. But it, truthfully, mathematically hard at a fund level to be able to do that. As an angel investor, it's different. You take some more shots. You don't need to, if you return 2 or 3x your money over 5 or 10 years, it's kind of fine. You're not on the hook and trying to raise your next fund. It's your own capital. So just very different dynamics. And I think, people are founders of all types will save themselves a lot of time and frustration if they, really do some upfront homework, learning how to speak VC and then how to approach the right investors in the first place.
Yeah. So I want to talk a little bit about more about, what is, who is an ideal founder? What should they know? Who does it right? What are the pitfalls of people who approach venture capital? And then I want to get into more specifics, which we, after you answer this one around like these times and the impact on VC.
Yeah.
But let's go there first. Like who, what should people who want to raise capital know? Who's an ideal founder? What do you guys look for? What are the mistakes people make?
This is going to be really general to start, and then
Sure.
I'll try to get a little bit more nuanced. I think the best founding team obviously has some combination of obviously strong technical differentiation and skills, and that can be proven out by their academic background, their past work history, the paying customers showing them that what they've built is useful and valuable. And then, that person combined with another one, whether it's, the other part of their personality or another person on the team, the senior level, who is just really entrepreneurial by nature. I always think if you were to pull somebody out of a larger organization and team them up with a technical CEO, it would be probably a product manager who's got experience talking to the engineers, but also going out, meeting customers, getting feedback, iterating quickly, not afraid to roll up their sleeves and create marketing collateral and try and get deals done on the sales side. I always think product managers are often called mini CEOs, and I truly believe that. And honestly, it's the most fun I ever had in my career too, was in that type of role. So I think those are the primary skill sets at the earliest stage they need to have, either through just a freak of nature CEO or founder, or through more commonly a combination of the two. Yeah. And then beyond that, I guess I'll give a little bit of a secret, I guess, or lesson learned from working with founders for a long time, is our best founders, the ones who outperform everything else and are just the scrappiest and get stuff done and tend to return the most capital and be the most successful for themselves, are actually doing it for some other reason than they want to be a founder, or they stumbled upon a good idea, or they did something cool in their past company. Most of them have some other really deep sense of obligation, either to a family member or friends or neighbors or somebody who believed in them, that they want to return the capital, return the favor, make them proud. Oftentimes it's mom or dad or a grandparent or somebody who believed in them. And other times it's a lot of times we have a lot of like great immigrant founders who, are first generation or second generation here, and so grateful for the opportunity to be doing what they're doing and make a difference in the world. And, those are founders that we usually over-select for, I would say. Getting to that can be a little bit challenging, understanding what those motivations are, but I can tell you a handful of stories of people who are just will not quit on their business and on their investors and everybody else. And it's really exciting.
Yeah, that deeper drive, that deeper purpose that, because we all know the entrepreneurial journey at whatever stage, whether it's when you start a company and hang out a shingle and trying to get your first customer, or whether it's when you're, at a stage where you're raising capital. There's ups and downs, and it's easy to walk away unless you have that intrinsic motivation. I do think, this conversation of the born entrepreneur versus, whatever. And I do believe actually there's more than two categories. I mean, I think like I can't breathe if I'm not like, I'm just not cut out to work for somebody,
Yeah.
I did my 5, 6 years in a law firm to get my experience. And then I was like, I'm out, and I knew I was going to leave. But there are plenty of people who are more situational entrepreneurs or whatever, who have something else that drives them, who could be successful. And then there are people who will never be entrepreneurs, and that's okay. There's no judgment on that. They're just cut out differently. But I do think that middle group, I don't think, curious as to your input on this, I don't think you need to be a born entrepreneur. I know many people who are successful, who are smart or whatever, who, they become situational entrepreneurs, but they do have something else that drives them, that has them not like easily look and go back to a job when things get tough.
No question. And, I think every founder, every person in the working world is making a risk calculation about how far they will go to bring what they want to do to life. And fortunately, that's not always a level playing field. Some people have a better fallback options and can, have a little more money in the bank or have a better support system or whatever else. Other people don't have that flexibility where, I can say this for myself. When I started Differential, I was, a single guy in my 30s with a lot of education behind me. I had enough money in the bank to go take this type of risk. And I remember, saying to myself when this started, I said, all right, here's the money I have to do this. Here's the money I have, but really don't want to touch to do this, but I will if things are going well. And then here's the oh shit, things aren't working. I need to move home and sleep on my mom's couch and get a job. But fortunately, I'm an otherwise well-educated guy with a bunch of relevant experience, could probably get a really well-paying job pretty quickly after sleeping on my mom's couch for a little while. So that was as far as I was willing to go. Other people cannot and should not take that type of risk. It's insanity. You got family and kids and whatever else depending on you. You can't always go there. So it's just a very different decision for everybody, I think.
Yeah. But I think that point of something else that's driving you is really, really important. That, and what's seemingly intangible, which is really a super important thing. All right, so let's start talking about these times. So I'll preview it with something. Let me know if you agree or disagree. But certainly coming into our COVID-19 experience here, in my experience, there was a lot of money out there, and available and flowing, and a generally good economy, at least in the realm of that impacts, VC. The public markets were strong and have since come back. So talk to us about, what was happening through, let's say, February, and then what changed potentially in March, and what's happening now.
Look, I think the reality is there's, in my opinion, there's just been too much capital and, frankly, too many startups in the market for quite a while now. Not everybody should be a founder, like we said. And I think having a job and having experience working for a boss that you may or may not like is a really good thing. Getting a paycheck is a really good thing. So in my opinion, I think through February, the market was pretty overheated. There were a lot of investors in the market in lots of different stages that probably didn't really belong there. Some of the family offices, angel investors, the corporates that just aren't incentivized in the same ways that VC funds are, I think, to be in the market for the long haul. When March came and COVID broke out and who could have ever predicted, nearly every business closing happening, a lot of that capital froze and dried up. And I haven't really seen that come back yet. But deal making has continued on. I think March and April was clearly slow. Everybody took a minute to catch their breath, figure out what the heck was going on, figure out how to deal with their kids at home, working with them, trying to teach them something and start your business or just hop on your conference call because you work for a big bank or whatever. And, they're running on 1995 technology. And it was just a brutal adjustment period for a lot of people. Yeah. I think for, speaking specifically about Differential and the markets we work in, we're all pretty tech savvy, hopefully, sure. and obviously we actually work remotely quite a bit. So we've got my partner David lives out in Philadelphia. He comes up or used to come up to New York, usually a couple of days a week. So we spent a lot of time on video calls anyway amongst ourselves. And in terms of for entrepreneurs and for founders, I think in April, May, June, I was getting worn out and had to put some more boundaries on my life because, the time zone challenges kind of went away. And I found one of the hardest things in VC that doesn't get a whole lot of sympathy is just the requests and demands for our time and money and everything else. And at some point you just have to say no a lot more. So I think you create a lot more access in a lot of ways. And I think, from what I've seen is most VC funds have figured out how to keep going and invest remotely and do deals without meeting people in person. And, I think it's fine. Like, you keep it moving. It's 2020, embrace Zoom. I like meeting people and shaking their hands and all of that, but I'm not sure we're really getting that much more out of that. I'm excited to go back to it, but definitely expect a different blend in the future. I mean, we did our first deal completely remotely, I guess, without knowing the founder beforehand at the end of June. And I mean, literally negotiating a term sheet with the founder, woman founder based in Toronto. And, she asked to have the call at 6:00 at night. And at, 6:30 or so, her 2 or 3 year old son was kind of pissed off that she wasn't out in the living room playing with him. So he came into the bedroom and we finished our negotiation with him staring at me on Zoom, wondering what this weird guy in the computer box was doing. And, it was kind of cool in its own way. It was a great way to get to know her life a little bit differently. And, we just go on. Like, that's what it is. Just be patient and understand these things are going to happen. And, I think the market is still moving along. So I'm kind of optimistic.
It's interesting because it raises two things for me. I remember, do you remember like a couple of years ago, there was a video that went viral of this guy who was on a news program and, and from home on video and his kid came in and then his wife like crawled along the floor and pulled her out.
Sure, yeah.
Remember that guy? Yep. And, I know, I don't know who he is. I don't know, but I got to believe he's thinking now, boy, I wish that happened like, 2 years like now, because that happens to everybody now. Like, it's not a big deal, like right. I'm on calls to dogs, my dog's barking, and like, it's just, it's like, it's funny. Yeah. So, the world, and I think the world has changed permanently. Interestingly, I've had this conversation with a couple of people because this is one of those situations where I sort of got ahead of the curve. And I actually, I got to be frank, most of the time in my career when I've been ahead of the curve, it's been more luck than anything. This time I actually figured something out 5 years ago. I had split up a law partnership about 5.5 years ago. And when I was evaluating, I was I had a team and clients and whatever, that I had previous. I'd gone into a partnership and then we were rolling back out. So all that was set. But when I was like looking at, okay, what do I want to do in terms of office space, that kind of stuff and whatever, I knew at that time I was about to get my place in California, that I would be back and forth. And I knew that, times had changed because, I'm older than you. I've been doing this for 30 something years. And there was a time where you wouldn't get a client unless you met them in person. Like, it just wouldn't, it wouldn't happen. But my experience was that there were plenty of clients that I didn't meet. I had to make my business to meet them. They would, we would have a phone call or a video call and, more often a phone call. I get an introduction. At this point, we have a certain, relationships, reputation, whatever. So we get good, intros to high-end clients. And, you'd have a phone call and I'd email them an engagement letter. They'd send it back. We'd bill them tens of thousands of dollars or whatever it is, on a, whatever. And, we'd never meet them. And then I'd have to make sure that, we had lunch one day, or if I was in their city, because I have clients all over the country, I'd stop by and whatever. So when I split off 5.5 years ago, we actually, we didn't promote it, but we have office space that we can go to mainly for meetings and that kind of stuff, or to use an office. But I set up my whole team to run remotely. So like you guys, we didn't miss a beat. We were already doing Zoom huddles. We were ready. And my clients don't care where I am. In fact, I remember the days when I had this big, Wall Street office, views of Statue of Liberty, the books in the conference room. And, that was how you created credibility. Now nobody cares about that anymore.
Yeah. I think this is this is not a good thing right now, but this will be a really good thing for everybody in a lot of ways. Like, I've always been sort of weird like this, where I always needed the right balance of being in the office and being able to work from home and just, manage my own damn life and travel a bit too. I used to travel a lot, and, that balance has always shifted a bit here and there. But I know if I got too heavily weighted in any one of those three areas, I went a little nutty. And fortunately, in my role now, I've kind of set most of that, and have some predictability around board meetings and things. So I need to travel. And I think that will just become more pervasive, even in big companies. I remember Iron Mountain, big old school records management company, back in 2010 or 11. Was already implementing an hotel style office location work arrangement. So you could work from home, pretty much whenever you wanted. And they downsized their Boston office, nice, new, clean, modern office. And you could just go onto the system, reserve a desk, reserve conference rooms, whatever you needed, get in, out, have your meetings. spend a day, spend a week, whatever. And you just had that flexibility. And I think we as a culture, as people, just need more of that. If you gotta go take your kid to the doctor at 3 PM, like, go take your kid to the doctor at 3 PM. So we know you're going to be working probably till 8 o'clock anyway. It's just the nature of work these days.
That's right. And on that point, it's a little off point, but it's interesting is like I've gotten two things that, solicitations recently. One is from a couple of the Vegas hotels, like MGM Grand, and one of the other ones who have this now, like, come work in Vegas. We have, Wi-Fi, and we have, like, we've set up the rooms to be your office, so it's, I love to see, as an entrepreneur and people who love, working with, companies and startups and entrepreneurs because of the ideation, and even bigger companies. I love to see how companies adjust, whether they're new companies coming out or existing companies, to new market conditions, because there's always opportunities. So it's fascinating to me. And then the other one I got was a thing about, or somebody, I think it was an article that I read about how different countries like Estonia, Georgia, Barbados, and there was one other, I forget, Bermuda, are trying to track people down. They're sort of like, hey, tired of working at home? Come live in Estonia or Bermuda.
Right.
From here, So
yeah,
it's really fascinating what's happening.
Yeah, I think it's good. I think it's a really good thing. It'll be healthy in the long run.
Love it. All right. So before I, do you have any last? Before I'm gonna let you, let people know where to find you and ask your last question. But before we go there, any last? Listen, I know we could spend an hour podcast on probably 20 aspects of stuff we talked about at a high level, right? So is there anything else, any particular thing about the VC world or working with VCs, or tips or pitfalls that particularly come to mind that you want to share with the audience?
Yeah, I would say a couple of things is be very mindful about how you present yourself and your company, and just do a little bit of homework up front. I mean, one of the things that VCs are judging founders on, I think, is just pure raw ability to sell. And I'm probably a little bit over biased on this, coming from a sales background. Do your homework before you come in. And I sort of blame the influx of blogs and everybody wanting to write about venture capital here. I think every founder read the same blog that said, qualify your investor and ask them, what they do and how they work with companies and things like that. And that's all true. But in your first meeting, if you've got 20, 30 minutes, 45 minutes or something, just get right to the point. If you have very specific questions about the VC fund or our partners that you want to hit in the beginning, like, let's do it. But I can't believe how many calls I get on where founder says, so, can you tell us what you do? And it's like, well, I feel like we know what we do. Like, we invest money. You're a startup. You want money, and
right.
Let's talk about that later. But like, tell me what you're up to.
Right. Do your due diligence on us later once you've sold us and we've expressed an interest. Then you can figure out what you want. Right?
Yeah, and it's totally a partnership, and we're competing for deals sometimes and all that.
Sure.
But usually at the seed or pre-seed stage, it's more so you're trying to get a VC to take to believe in you and take a absurd risk in your company and in you. And I think most of that stuff around like qualifying your VCs and your investors a little bit more of the later stage, where it's really competitive at the Series A, Series B, and I think that's when the tables are flipped a little bit. But early stage, come in ready to go. Do your homework and get right to your kind of big selling points. And for me, I actually have blogged about this, is in your pitch deck and in your presentation, it's what are you doing, why is it important, why are you uniquely qualified to solve this problem, and then what proof points do you have? And if you can't get through that in 5 minutes, then you really need to kind of keep tightening up your pitch, I think. So that's always my advice. Just do your homework and come prepared, and get those things out of the way as quickly and efficiently and impactfully as possible.
All right, great. So if people want to find out more about you, Differential Ventures, where do they go? And in your case especially, I'm going to say also, usually I just have other kind of guests give the contact information, but I know a lot of VCs I'm sure you're inundated with a lot of non-qualified, pitches already. So maybe give a little guidance in addition to how people can get in contact, with you on, on anything you want them to know about what would be appropriate, to reach out to you.
Yeah, sure. So, everything we invest in is technology. You've got to be pretty early stage. So if you've got several $1 million in revenue, you're too late. if you're not a tech company, you're probably not a fit. We also mostly focus on B2B type software, not really consumer apps or things like that. But if you're in the B2B world, you do anything in and around data science, AI, machine learning, et cetera, you're kind of right in our sweet spot. Those are the best pitches. But always feel free to send things over. We actually do look at each and every deal we receive. We can't get back to everybody with a yes or a no. We're on track to get about 3,500 pitch decks this year. So we're a team of 5, so we can't get back to everybody, but we do our best, and everything does get looked at and reviewed by somebody on our team. So I can assure you of that. The best place to reach me, and I'll just put out there, my email address is Nick, N-I-C-K, @differential.vc, and get a lot of emails, so you may not get a response from me right away, but it does get into our system. We will look at deals and so forth. You can obviously send me anything on LinkedIn. LinkedIn is kind of a cesspool of stuff and really hard to manage because there's no message management function in there for whatever reason. So man, stuff gets pushed down. So odds are you won't hear back from me on LinkedIn, but even if I do accept your request, because it just gets buried within a day. So yeah, Nick @differential.vc is the best place to go. That's our website, differential.vc. I have a Twitter account, but I'm not super active on there. It's just ADAMAMOS and the number 11. You'll find the occasional nugget from me there.
All right. Awesome. That's great, Nick. So listen, my last question on the podcast is my highest ideal in life is freedom. And I wear a little myintent.org bracelet with a little thing that says freedom on it. It's the only jewelry I wear, actually. For me, freedom means everything from freedom from oppression for all people, at that level, to the reason I'm an entrepreneur, right? Why I don't work for somebody. And the freedom to create and run my life and live the life I want to live. What does freedom mean to you in your life and business, and how does it impact, how you invest as well?
Yeah, I think I really appreciate that question. That's a good one. Yeah, I have a pretty unique journey to venture capital. And I think I have a lot of appreciation for the opportunity I've been given because, I did not grow up rich by any means. Actually grew up pretty poor at sometimes, and, had a pretty unconventional family life growing up. I didn't really have that many role models to go to Stanford or Harvard or MIT and go on and become a venture capitalist. Just wasn't there. So I've kind of backed into it, and I've been really fortunate to have some cool experiences from the time I was 18 and onwards, from starting in college, to just really round out my view of the world and who I surround myself with. Freedom for me has I've been given the unfair opportunity of, despite having grown up without much money and kind of direction on the professional side of things, I still had a lot of other things working for me, being a reasonably intelligent, athletic white male. I had a pretty good spot in life. And since then, I try and give the advantage and give the extra time to anybody who didn't have some of those same benefits that I did growing up, to try and create a little bit more opportunity for other people as we go in the world too. So for me, it means being able to do what I love doing, which is this. If I couldn't play shortstop for the Red Sox, which as we've documented, I could not, I'd absolutely want to be a venture capitalist. And I get up excited every single day to go work for my partners and my investors and our founders. So for me, that's my freedom. I just love what I do.
Nick, I love that. And I also love, you and I offline will continue to have some conversations, because the alignment around creating opportunities for others, especially people who, don't have some of the advantages that, because I'm similar to you, grew up in a lower middle class family, not, we had a roof over our head, but it was always paycheck to paycheck, but I did have some advantages, as well. Just, you mentioned being a white male, so we align on that as well. So we'll talk about more about that. But in any case, for now, we are at our time. I really appreciate having you on as a guest on the DealQuest podcast. Super appreciate it, Nick.
Thanks, Corey. Really appreciate it.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. You can be a friend of the show by leaving a review on the Good Pods app, podchaser.com, or any major podcast player. Every review helps the show reach more listeners. If you're ready to take your deal making to the next level by becoming a master negotiator, head over to Amazon or Audible and grab a copy of my best-selling book, Authentic Negotiating. Then connect with me on LinkedIn and let me know your thoughts. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.